Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about Algonquin Power and Utilities stock. This is a series of videos in which I will analyze the top Canadian stocks in green energy sector, and I started with TransAlta Renewables and Northland Power, and in this video I will focus on Algonquin Power as our last Canadian renewable energy company. I will do a wrap-up video on renewable sector and compare these three companies with each other, so if you want to watch that video, make sure to subscribe. In this video, I will discuss the Algonquin Power business, their future plans for 2022 and beyond, their dividends, the risk associated with this company, and finally I will provide a detailed stock analysis using my personal discounted future earnings model, and will then provide you with the fair value of this stock depending on your investment goals. The company HQ is located in Ontario, and their shares are traded on TSX for almost 18.7 Canadian dollar at the time of recording this video. They pay a dividend with a yield of approximately 4.65%, and the market capitalization of the company is around 12.6 billion Canadian dollar. Before starting the video, I want to emphasize that I'm not a financial advisor, and this video is not a financial advice for you to buy, hold, or sell this stock. This is just my personal opinion, and should always do your own research before making any financial decision. With that being said, let's start this video. Algonquin Power owns and operates a portfolio of regulated and non-regulated generation and distribution of power and utility assets in Canada, United States, Chile, and Bermuda. They pretty much have two different subdivisions. They have regulated utilities including electric, water, and gas utilities with over 1 million customers in 13 US states and 1 Canadian province. And they have the renewable power generation business. In renewable subdivision, they own hydroelectric, wind, solar, and thermal facilities with almost 2 gigawatt operational capacity and 2 more gigawatt capacity under development. The company has a lot of facilities under development and has planned to acquire new utility businesses in the next few years with around 9 billion Canadian dollar investment in regulated services and 3.6 billion in renewable sector. Here we can see a list of projects that company has under development by 2026. They are also invested into EV chargers, the solar farms for their renewable business, and also microgrids and advanced metering for their utility business. Here we can further see a list of their projects which are mostly under development in renewable power generation subdivision. The company anticipates to invest heavily into developing and buying new assets by 2026, and most of these projects will be funded through debt and maybe some shared dilutions. For 2022, they anticipate a very slow growth in the adjusted net earnings per share or EPS from 0.71 to 0.72 in the worst case, which means pretty much no growth at all, and from 0.71 to 0.77 in the best case scenario, which is still a very slow growth. So anyway, in 2022, the company will not grow that much. However, in the next 5 years, they expect to be able to deliver 7 to 9% year-over-year growth in the EPS numbers after finishing the current projects under development. If we look at the financial statements of the company, we can see growth in total revenue, but fluctuations in the EPS number, operational cash flow, and of course free cash flow of the company. We can also see that while the assets of the company growing fast, this debt is also growing exponentially. The reason for all this fluctuation is that they spend huge amount of money on developing new projects, buying new assets, and also repairing the current assets. Algonquin pay a nice dividend with a yield close to 5% at the time of recording this video. They have a history of increasing the dividend with an almost 10% year-over-year growth in the dividend in the last 10 years, which is an amazing track record. They have an 80 to 90% payout ratio target for normalized earnings per shares for the future, which means they will probably return most of their adjusted earnings to the shareholders via the dividend. One interesting point about Algonquin Power is that they pay their dividend in US dollar and not Canadian dollar, as most of their business is in US and not Canada. It means if you hold this company in your Canadian account, your broker probably converts US dollar to Canadian dollar when paying you the dividend, and it is something to keep in mind when investing in Algonquin Power for dividends. There are some risks associated with Algonquin Power, and the most important one is the balance sheet risk. In the last 2 years, the free cash flow of the company was actually negative, and they spent almost all of their operating cash flow for paying out the dividend. Even the management clearly mentioned that they want to pay out 80 to 90% of their adjusted earnings to shareholders as dividends, which means they have little to no money left to reinvest in themselves in the future, and the only way for them to grow is using debt. And we know the interest rates are rising in the future, which can make their business much less profitable. They also had some major issues with their assets. As one example, their Texas assets had basically issues with extreme weather conditions in Texas early last year, which caused some problems for Algonquin Power and their wind farm over there. Overall, Algonquin Power does not have the best balance sheet in the world, and there are some risks with investing in such a debt-heavy company. But the management were able to navigate the company through challenges in the past, and they will probably be able to at least continue to pay out their dividend. This is my favorite part of the video, where I can show you my stock analysis based on the financial data I discussed in the previous parts of the video. Here I use a discounted future earnings and not discounted cash flow, as the cash flow of the company was actually negative in the last 2 years. In this model, I basically estimate values of the stocks based on projections for the future earnings. So I make some assumptions about the growth of the company in the next 10 years and then discount the future earnings into the present value of the stock based on my expected rate of return. So I start with the past 4-quarter adjusted earnings per share of the company. And based on 3 different scenarios, I predict the future earnings of the company in the next 10 years. In the bear case, or the most negative case for the stock, the company can only grow 6% in the short term, and then the growth will drop to 5% in the long term. I considered a terminal multiple of price to earnings of 8 for this case, which is consistent with historical bear periods for this company. For normal case, I considered a little bit better growth and a terminal multiple of 16, which is historical average multiple for this company. For the bull case, or the best possible outcome, I consider the business grows by 12% in the short term, and then the growth rate drops to 9% in the long term, which is probably the most bullish prediction for the future of this company. I considered a terminal multiple of 24, which is the bull multiple for this business. Now I assign a 50% chance to the normal case, a 25% chance to the bear case, and 25% chance to the bull case. For growth stocks, I usually expect 15% return year over year, and for dividend stable stocks, I expect 10% return year over year. If I expect a 10% return from this company, the fair value of the stock is almost 10 Canadian dollar, which means compared to the current share price of 18.7, the shares are traded at 47% premium, and it is not a buy according to the model. This means if you expect 10% return on your money year over year, this stock is probably not going to deliver that 10%. In my opinion, the dividend is the major part of the return you get with this company at this price. And you cannot really expect much more capital growth in the next 10 years. It's always fun to see what analyst predictions are for a company, and according to Yahoo Finance, the analyst price target for this company is currently at $20.7 per share for 2022 with a buy rating. Algonquin is a good dividend payer with consistent growth in its dividend, and they are invested in development of more renewable assets in the future. Unfortunately, it is highly unlikely that you can get 10% year-over-year return with buying this stock at this level, but if you're happy with 5 or 6% return year-over-year on your money, then Algonquin Power can be a stock to buy here. I would personally avoid this stock at this level, as it cannot provide 10% year-over-year return. I hope you enjoyed the video, and if you enjoyed this video, please leave a comment and let me know what stock you'd like me to review next, and please consider subscribing to the channel to see similar videos. Thank you for watching, and I see you in the next video. Farewell.